Hello and a very warm welcome to everyone. I am Shrija Agrawal and it's my sheer pleasure and privilege to be welcoming you for a thoughtful discussion series titled India Restart. The entire idea behind the discussion series is to come up with some solutions and ideas on how we are looking at rebooting the Indian economy, looking at horizon encompassing short-term measures, medium-term and also the long-term. The approach that we have taken is to bring new ideas, new lines of thinking. Some of them could also be unconventional to the table and also perhaps question some of the basic assumptions that we have worked with till now. As of now, the pandemic has caused a shock for the Indian economy. The four legs, consumption, manufacturing, exports, and capital flows, on which the Indian economy has been growing, have all been impacted adversely. PM Modi's clarion call to industry leaders at a recent CII meeting was that he's confident of getting the growth back. But according to a recent Reserve Bank of India survey, consumer sentiment is at a historic low, at least the lowest recorded in 6 years. There's worry about financial security and job security. Private investment is anemic. Banks are still parking more than rupees 6 lakh crore back. Amidst all the conversation about getting back growth, money creation is of huge importance. Most of the money in our economy is created by banks in the form of bank deposits. The numbers that appear in our accounts. Banks create new money whenever they make loans. It could be good to understand how do we fare on this aspect of money creation. It's almost fashionable to compare India and China when spoken about manufacturing, supply chain, startup ecosystem, and so on. The comparisons often drawn between the two economies. We have a pretty meaningful panel here and an unusual one. Saugata Bhattacharya, who's the chief economist at Axis Bank and the very respected voices in the Indian banking and economy sector. I also have with me Vinod, Tharakan, a serial entrepreneur with successful technology businesses in India and the United States, supporting the financial services industry for the largest banks and credit unions in the United States. They have JP Morgan Chase and Wells Fargo Bank as one of their clientele. Today's discussion on money creation is to essentially review the top-down perspective of established economic thinking in India with the bottom-up perspective of a fintech technology provider. Let us see where do we land, and the idea is essentially to attain clarity through debate. Gentlemen, it's my sheer pleasure and privilege to be hosting you this series, the first dispatch of India Restart, largely focused on money creation. Vinod and Saugata, welcome to the show and thank you for your time and energy to this.
Thank you, Shrija.
Thank you very much for having me on your show.
That's good to hear. I would sort of like to begin the conversation on, sort of really charting the wealth creation journey between the two economies, India and China. It's often been talked about. Vinod, would you want to sort of do some context setting as to what is your research saying, given the fact that you have worked in some of the established economies like the US, especially in the banking sector? Yeah.
Right. Thank you, Shrija. And firstly, thank you for having me on the show and really looking forward to sharing our perspectives. What we have been seeing is, like you mentioned, we have been involved in delivering technology solutions in support of a lot of the stimulus programs that the government in the United States is doing. And this was of interest to us to kind of compare and contrast the actions being taken in the Western economies vis-a-vis the policy decisions being taken here and the pros and cons of each. So a lot of the perspectives that I'm sharing here are just driven by the data, the empirical data. If you look at India and China, not from a political standpoint, from just a perspective that we were two countries that were equal in 1990, just 30 years ago. We had exactly the same GDP, with China being 360 billion and India being 320 billion. And now we have China at 14.5 trillion, and India is just crossing 2.8 trillion. So when we started looking at that and started looking at the numbers, the empirical data clearly shows that today in China, they have a money supply of close to 28 trillion crores. In India, money supply is in the region of $2.6 trillion. $26 trillion, I meant. $28 trillion in China and $2.6 trillion in India. So why the big gap? So when we continue to dig into the data, what you see is in China, they have a total bank assets today of in excess of 41 trillion US dollars. In India, our bank assets are in the region of, again, $2.5 trillion only. And in China, about 97% of the money supply is driven by bank credit. In India, it's about 85%. So looking at all this data, starting 30 years ago with just in the 300 billion region, and today we are in the 14.5 trillion range in China, and in India, we are very, very behind that. The source of the issue very clearly is the fact that we do not have a system in India where credit is easier to access, and also the interest rates in India do not contribute to the support for businesses to be productive and actually run businesses successfully compared to the interest rates you see in places like China or in the West. So we think the fundamental problem here is just making it easier for businesses to access credit, and also do it in a manner where if the interest rates, which is the cost of borrowing, can be brought down for productive businesses that are directly contributing to the GDP, we can avoid inflation, which is obviously the biggest issue and concern when you talk about money creation. So the banks are empowered to create money. The summary of it is every time a bank makes a regular loan to any of us, right, whether it's a personal loan or whether it's a business loan, that is actually recorded in the books of the bank as a deposit, which is an asset for the bank, and then it's available as money to spend for the borrower. And this loan is actually new money circulating in the system. So if that is how the system works, then we should be encouraging the creation of new money to productive purposes that can avoid inflation. And I think we have a good chance of very rapidly growing the economy from where we are today. So that's just a few data points that I want to share in my initial position.
Okay, Saugata, I would like to bring you into what Vinod just said, that, creation of credit, creating new money for more productive purposes in the economy is his moot argument. And he of course, is drawing parallels between India and China. Both essentially began the same time frame, but perhaps the end result is different from both the economies. Why so? From a perspective of established economic thinking in India, what can you provide as a view on this, or perhaps a counter view to this?
So again, let me compliment Vinod Saab for a very comprehensive introduction. Very, very stimulating, thought-provoking statement. Let me start with China first. So obviously we know, we are all the efforts of the initiatives of the current government in the Atmanirbhar program, how to increase India's competitiveness, domestic competitiveness, increase our export share of the global trade, etc., are geared precisely towards this. That we've learned a lot of lessons from China, and we are trying to fix our system. So keep in mind, Vinod is absolutely right that China's cost of capital is much, much lower. Yeah, so it's so that's 0.1A. It's much, much lower than in India. India, we suffer. Not just in terms of China, many of our other emerging market export competitors, our cost of capital still remains relatively high. But remember that cost of capital is only one part, one part of total expenses. If you read Tim Cook's interview in, I think, somewhere in March or April, he mentions that Apple is not in China for lower costs, particularly low cost wages, labor. It's because China is a very productive base, and the entire ecosystem that they have created for investments, particularly for a company like Apple. He gave the example specifically of this app development. The entire apps that are being developed in China make it very profitable for a company like Apple to sell its products which are compatible with these apps. So India is not just a high cost capital, it's our cost of other factors of production, land, labor, many other inputs. I think are equally high. In particularly in comparison to China. In a typical corporate balance sheet, profit and loss, P&L, and a balance sheet in the current times, costs of the interest cost, which is essentially the cost of capital, still remains. It varies widely across sectors. More capital intensive industries, less capital intensive industries. Anywhere between 10% to 20%. So a much larger costs are OPEX costs, other costs, etc., which contribute to the total output revenues. So point A is that capital costs are only one part of the costs, which explain the China-India growth trajectory differential. There are many other costs of electricity, cost of land, cost of labor. Although our labor costs are relatively low, the unit labor costs, as economists talk about, that is labor costs adjusted for productivity, still remains very, very high. It's one of the highest in the world. So that's point number one in terms of the China story. So we need to cover a range of inputs, land, labor, capital, etc. In terms of capital, I think you will see that the current, this has been a major plank of the government's reform programs. Things like IBC, for instance, the inflation targeting regime. So the central bank, as an inflation targeting central bank, was designed to get inflation down, because that's a key input into the interest costs that economists typically take. So, the focus has been to try to reduce interest costs, and interest rates have come down over the course of the last decade or so. It has definitely come down, but we are still very, very high. And the current focus is particularly to try to lower interest costs, which is the reason for the steep repo rate cuts that the RBI has done, the flood of liquidity through TLTROs, LTROs, other infusion mechanisms, injection mechanisms. So all of that is designed, and it has worked. 3-month commercial paper now, particularly for working capital credit, is almost at the reverse repo rate. So the final point that I'm going to make is that when we talk of money, we have to be very clear on the definition of money. Just like we talk about interest rates are actually broad spectrum of rates, starting from the overnight policy repo rate to overnight interbank rates to all the way to the 10-year paper, then the 10-year AAA paper, and a whole bunch of other stuff. Similarly, money is the concept of money is a very is a wide range concept. So you start with the base M0 concept of money, which is what the Reserve Bank creates. Banks, remember, do not create fiat money. Neither does the government. It's basically a transfer. So the only entity in the country which creates money is the Reserve Bank of India, which is the M0 creation. Then on top of that, you have the M1, which is the transactions demand for money. So which is essentially the current accounts of banks. And then the entity that Vinod is talking about, which most closely resembles his concept of money, is what we call broad money, which is M3. So let me stop here at this point in time, and then we'll take this other thing.
Vinod, he's talking about the fact that in the definition of money, he's talking about what you sort of essentially are talking about is more M3 nature of money, but there's huge convergence from both the parties that, of course, the input cost of capital really needs to get lower, and how the government is trying to take measures to get there, be it through the IBC program or the interest rate regime. So what have you seen, Vinod, in perhaps in other economies, as being a successful banking, financial technology services provider? What really were the banking policies that allowed China to successfully create so much more money than India? What did you see?
Right. So that was very good perspective shared by Saugata. I want to share some data in relation to some of those points, right? So if you really look at China and the credit guidance policy that China has, they have a very focused approach that they know in their economy where do they want to boost areas and where do they want to go careful because there might be oversupply. So they are monitoring it. And of course, because of the way the political environment is in China, it's easier for them to implement policy once they decide. So for example, in that example with Apple manufacturing in China, because China is now at the forefront of absolutely high quality manufacturing. But how did they get to where they are today? They didn't start as a high quality location, right? They got to where they are today because they have the right policies in place to promote the creation of the assets in the country, the manufacturing and productive assets in the country to allow for that level of quality. So what I mean by that is, just like that Apple example, if you really look at the situation in China when the Google DeepMind artificial intelligence team, they launched their AI program that actually beat Lee Sedol, the world champion in the game of Go, That is being referred to as the Sputnik moment in China. And what that means is they woke up to the fact that the future is all about artificial intelligence. And now a lot of their credit guidance is targeted at becoming the world leader in artificial intelligence by 2030. So the perspective I want to share there is we are not really defining policy based on the needs of our country. That is the broadest point I want to share. I want to also share a couple of data points. We can also have a credit guidance approach in India where you can make the cost of credit extremely low, literally give loans at 1% interest if it is targeted at productive areas where the nation really needs a lot of strength. So for example, maybe we need to really focus on credit guidance for silicon chip manufacturing because the future is all about Internet of Things and we are deficient in those areas. Maybe we need to have credit guidance on defense spending. I mean, you can see there's a lot of excitement in the country today because we have acquired some of the fighter jets now from an international country or importing them. But this is 30-year-old technology. The future of warfare is not human beings fighting with each other. The future of defense and warfare is autonomous systems. So if we wake up to the fact that we need to start focusing our credit guidance through policy to really growing some of these sectors, we can truly be world-class, not just be on par with China, but actually even exceed what China is doing. Because understand one thing, right? That there is hardware and there is software that drives the world. Now, China may be at the forefront on the hardware side in every sector, but without a doubt, India is at the forefront on the software side. But we do not have the right policies that make it feasible with credit guidance to encourage growth in these industries that can actually allow us to leapfrog where the others are, not just China, but even the rest of the world like the United States. And I'll give you a simple example. If you look at the stimulus support that was done in the United States that we were a part of, specifically the Paycheck Protection Program. So the Federal Reserve and the government in the United States came out with the policy that they're going to fund the payroll costs of all their small businesses having up to 500 employees. And if those funds were utilized for the purpose of meeting their salary requirements, they can have those loans forgiven. And for portions of the loans that were utilized for other expenses, the interest rate is just 1%. Now, the government has tried very hard in India to stimulate the economy given the slowdown, but we still don't have a rational approach towards the cost of credit because that has not come down. Yes, the banks have been protected by the fact that these are now government guaranteed loans that the banks are allowed to make to the small businesses in India, but you still have a situation where the cost of that credit is relatively high. I mean, most of the cost of returns for a lot of the businesses that we support are looking at a capital return of 4% annually. In India, you can't even get a loan for 10% if you're a business, right? And on the banking side, there's a big concern there because of the rise in Npas and such as well. So I would say credit guidance is a key theme that we are lacking with, where we need to have a differential approach to which sectors need to be supported by lowering the cost of credit. And even if there is a high rate of NPAs, does it really matter? As long as there is productive output. Look at what the West is doing. When there are NPAs in a productive sector, the central bank is actually taking over those NPAs and making the banks whole to kind of ensure that the banks are not too concerned about that part of stimulus, right? So that's just a few points I wanted to share because I think what Saugata mentioned is very relevant about the situation in China. But I think we can learn a lot from not just what's happening there, but what's happening in the West, which is to have a very focused credit guidance policy to stimulate the areas that can be in the best interest of the future of the country.
Interesting. I think the conversation just got very interesting and intense here. So instead of just dwelling in the past, we are actually the conversation forward here. Saugata, I would wonder sort of what is your response? There's two key points mentioned by Vinod, and I think they're very relevant. And he really articulated that we are not defining policies basis the needs of people, and perhaps we need to have a more credit guidance approach for particular sectors to meet their peer is very relevant, and perhaps unconventional lines of thinking which could perhaps be implemented. What's your view?
So no, so I mean, obviously, I mean, Vinod's suggestions are very, very attractive. I mean, I think even sitting here, I was at some point, I was almost half convinced. But you have to be very careful. India probably has one of the highest, largest degrees of credit guidance anywhere in the world. For every rupee of deposit that banks get, 19% has to be earmarked for the government. It's called SLR. 40% has to be earmarked for priority sector lending, right? So priority sector, including 18% for agriculture, 10% or so for MSMEs, the small parts, for weaker sections, etc. So that's anyway, for every rupee that the bank gets in, then there is a 4%, 3% currently CRR. So there is a 19% SLR, a 40% PSL, priority sector lending, which is specified lending to specified sectors, plus a 4% CRR, 3% CRR. That's easily about half the money is gone. Half the rupee that you get in deposit is gone towards sequestered lending. I can't imagine very many countries in the world which has a stiffer credit guidance as like India does. Secondly, in terms of credit guidance, if you think that some sectors are worth championing, and the government is looking at this. I mean, the government has already identified 10, 15 sectors where it wants to push national champions. I mean, it wants to push in technology champions, etc. And India has already developed a fair bit of expertise in some engineering segments. You know, some engineering like advanced pumps, specialty chemicals, some textiles, etc. We are already world class. I mean, you know, we are exporting stuff in a lot of segments. But there are other sectors that the government wants to push. The recent example of credit funds, broader funds, not credit, flowing into one particular company, we all know that company. That company has got about more than $21 billion worth of capital in the 3 months of a global lockdown. Why? Because global investors now are awash with liquidity at zero or negative interest rates, and there is a push for looking for yields. India is still a very, very attractive macro investment story. Very attractive macro investment story. And investors are looking for these rates. I mean, a 5%, 6%, 7% rates, when in the domestic economies, they would get a negative or 0 or 1 or 2% rates. So, I mean, if you have a bankable business model, a bankable business, a sector where risks are controlled, credit is not an issue. You will get funds, global funds, maybe not domestic funds, because we are still not that rich a country. Yeah. So you do not need an active credit guidance. There is a large debate on the side now on funding infrastructure, because banks, particularly most of the funds that banks have, the average maturity is about 2 to 3 years. It becomes very difficult and risky to try to fund long gestation infrastructure projects, which are essentially 5, 10, 6, 20-year projects with this short-term money. There's the rollover risk, as many banks have found out in the West, if there's an asset liability mismatch. I mean, you are subject to severe liquidity stress when conditions, for financial markets conditions become volatile. Yeah. So that's a separate debate going on, that what are the kinds of institutions, and it is particularly for this that we are trying to develop an alternative to bank credit in terms of corporate bonds. Yeah. So that's one part of the story. In terms of NPAs, the basic principle of the NPA, it's like a private equity type of game, venture capital, which Shrija is so familiar with. You know, of the 10 investments that a VC or a PE makes in fresh investments, probably 8 or 9 will fail. But the idea is that you make so much out of that one successful bet out of the 10 that you've invested your funds in, that more than makes up for the 10 losses of the 8 or 9 that you have in your portfolio. Yeah. It is exactly the same thing with bank credit. It is the difference between what are the top line NPAs in the system, which are known as the gross NPAs of the system. Banks need to make provisions, and then you get a net NPA in the system. So depending on the business model, banks are regulated entities. Remember that banks have depositors' money. There's a very big prudential exercise Yeah. So, I mean, there's a banks have a very large fiduciary responsibility to depositors. Banks are not in the capital markets game. So banks have to be very, very conservative in lending if you want to avoid a 2008 global financial crisis type situation happening in India. Yeah.
But
And we've already got.
Yeah, I have a view on this. I think economies really can't be built on foreign capital. Number one, I mean, you need to have, you have to stimulate investment. I think we are in a situation right now where banks are finding it more prudent to park rupees 6 lakh crore with the RBI. And perhaps there's so much of aversion to put that money to work. I mean, are we really talking about this possible dearth of bankable projects in India? So there's, of course, this huge fear of NPA, which is looming very large in the minds of bankers. And one can really understand that where they are coming from, and which is why we have a robust IBC. But the question really is that where do you go from here? I mean, we are really stuck and stagnant as to what we are speaking, of course, reeling under the pandemic. But if you're talking about rebooting the growth, it really can't be parking the money with the RBI.
And I just want to come back on a couple of points here, Shrija and Saugata, because I would diverge quite a bit here from what Saugata has mentioned. In terms of credit guidance and in terms of the banks maintaining deposits with the RBI, that is just supporting the Basel III norms of the banks maintaining their certain regulated reserves with the RBI, which is 3% of CRR and 18.5% SLR, right? It has nothing to do with the real economy. It is just a policy that tries to ensure that the banks have enough reserves to meet liquidity requirements when there is a demand on their capital, okay? So I think there's a little bit of a disconnect there because I'm not really talking on the bank reserves. I'm talking about the real economy. And the other point I want to make is that if you really look at the key problem, I feel is a proper understanding of the concept of money creation, right? So yeah, my position is India does not need any foreign investors. India does not need any FDI to come in to kind of support a lot of the sectors that we need investments in. And let me just give you an empirical example of that, right? Today, if in the state of Kerala, where I'm based, if we needed 10,000 crores for a certain project, and Bill Gates came and said, listen, I'll lend you the money, okay? You've got to understand that if Bill Gates is, and I'm just using a big name like that to kind of just make it this thought experiment valid, right? So he's ready to lend us $1.5 billion, let's say, at zero interest, okay? What you got to understand is that money is not crossing the boundaries of a country. That money is just held up internationally in the correspondent banking account. And if that is given to Axis Bank, where Saugata is right now, Axis Bank then releases 10,000 crores to the party who's receiving the funds in India. And for all practical purposes, 10,000 crores of new money was created in India that is now sloshing around in the economy, could impact inflation, could impact all the dependencies of increasing the money supply. So my question is that if we are trying to approach money creation and we are willing to allow an investor to bring in funds by just providing an asset internationally on the basis of which a bank in India can release funds and create your money in India, then why can't we just do it directly, right? It is practically the same thing. If Axis Bank signs up with a borrower in India for the purpose of a 10,000 crore loan, that money is practically being created in India as well. So let me quickly jump now to an NPA, the NPA question, right? Why should we worry about NPAs if those loans were productive? Why can't we do what the Federal Reserve in the United States did, or what Japan did after the Second World War, or what the UK did in the 2009 crisis as well, which is they bought the Reserve Bank or the central bank, bought over the NPAs and freed up the assets on the books of the bank so the banks could have be freed up from those non-performing loans and continue to lend and support the economy. So I think there are two disconnects that I feel I'm struggling with when I'm having these discussions with my peers in India is why is there a lot of noise around the understanding on the concept that a bank is the authorized entity to create new money, and even if it's credit, for all practical purposes, Shrija, if you get a loan of 1 crore, that is real money in your hands to spend, right? And whether the source of that was an international investor providing you that money, remember that foreign exchange is not crossing the borders. It's held as reserves internationally, and new money is being created within the country. And I just feel that it's a simple concept once you wrap your head around it, but I think there's a lot of noise that prevents the spotlight on the reality that this country can create as much money as it wants as long as it controls inflation. And we should probably touch on inflation a little more as well. But I just want to kind of make that point and just listen to your responses.
Saugata is an established sort of economic thinker. I think sort of to what Vinod just mentioned right now, I think a sort of moot argument is, of course, on money creation. And the point is sort of, you mentioned that why can't they be loans, alluded more towards productive purposes? And why do we need foreign direct investment or foreign capital? Then why can't we do that, domestically in India, where the reliance on foreign capital could be substantially reduced? I want to understand, perhaps what he says, some of them can sort of appear unconventional or radical also to some. And he's also mentioned that he's having a disconnect in his conversation with peers in India. Perhaps you could demystify as to where that is.
So a couple of points. I think one part is Vinod's argument is not unconventional. It's not correct. This is about the money creation part. Remember, I'll come back to that later. His first point on India not requiring external funds, foreign funding, is not really correct, because this is where India's current account deficit comes in. At one point in time, our total investments were about, at the peak of the investment cycle, pre the global financial crisis and a couple of years before, almost 38-39% of GDP. And total savings at that point in time, this was one of the highest growth rates ever in India's history. I think domestic saving rates had gone up to about 32-33% at that point in time. So that still left a gap. So you are needing 38-39% of your GDP for investments, but your domestic savings are only about 33% at the top. I mean, things have stabilized now downwards. In India's case, particularly of this 33% of the peak of the peak savings, domestic savings, almost 13% of this was in the form of household physical savings, so which was not available to the government, to corporates, to all India financial institutions. That was just households building their own houses, buying cattle, etc. Not gold, buying cattle, etc. So, I mean, assets were getting created, but they were not transferred. So, banks' role is to take deposits from households, others, and give it to corporates, to the government to invest in productive assets. Yeah. So, there is that gap. A large part, I think, of the current Atmanirbhar program, the government's Atmanirbhar program, is trying to incentivize domestic savings so that we are not dependent beyond a certain extent on global financial capital pools. So that's part of the initiatives of the government. Second, in terms of the low-cost capital, I think this is exactly one of the models that is now being sought by the government using the National Infrastructure Investment Fund, NIF, using equity money sourced from very low-cost or zero-cost global sovereign wealth funds, so Abu Dhabi Fund, Canadian pension funds, etc., investing, and then trying to invest in Indian infrastructure projects. So, which is exactly the low cost. Japan has a whole bunch of programs through JBIC, JICA, using very cheap 0% long-term concessional loans, etc., to fund infrastructure projects. So that is happening. So we are dependent on that. And then thirdly, we are trying FDI investments. So this now brings us to this very important question of why can't Axis tap a global pension fund and bring in that money and invest in the country. So suppose Axis were to get to source $10 billion from somewhere, bring in that $10 billion, convert that into Indian money. But what happens to the dollars? I mean, what the $10 billion that came in, India can't use dollars. Remember? I mean, so dollars is not an acceptable form of currency in India. So it has to be held by somebody who's going to hold that currency. Some part remains in the Nostro accounts for transactional purposes and for managing the mismatches in flows, etc. Very small part of the $10 billion. So who's the natural part? The first thing that happens if nobody wants those dollars is that the price of the rupee actually plummets. So the rupee with a $10 billion inflow that comes in, say, over 1 month or 2 months. Remember what happened when BP, British Petroleum, came in with the Reliance money. The rupee shot up to something like the 63% range. Our exports will vanish at that point in time. So the obvious candidate, which is exactly what the Reserve Bank of India has done very, very correctly in my point, in my thinking, is that it intervenes in the foreign exchange market, buys up that dollar. Yeah, the $10 billion that Axis has, because otherwise there's no use for the dollars in the system. It either has to be repatriated, which means that somebody has to buy the dollars, and that 10,000 rupee and the rupee equivalent of the dollars vanishes immediately. So then the Reserve Bank of India buys those dollars, the $10 billion, which is exactly what the Reserve Bank of India has been doing. That's why India's forex reserves have now crossed $500 billion, close to 510. Probably now, because the Reserve Bank of India has been buying up the foreign currency flows to try to keep the rupee, the level of the rupee, to prevent the rupee from appreciating very, very rapidly and making India's exports uncompetitive in this current environment. In the current environment, of course, the current account is also surplus, which is adding to the problem, but that's the problem with it. So again, I come back to the initial definition of money. When we talk about money creation, the base money, the fiat money that is in the system is only created by the Reserve Bank of India, not the government, not banks, not household, nobody. The base money, which is the total base of currency in the country, is only created by the Reserve Bank. And one of the ways the Reserve Bank creates money is by using foreign exchanges, by buying foreign exchange, which is typically in RBI technical lingo is called net foreign exchange assets. There are valuation components, etc. But a large part of that is actually the RBI buying assets in the system. Yeah. So you have to be very careful. So once the Reserve Bank of India creates this currency, buys up the $10 billion that Axis would have got, and then releases the equivalent rupee back into the system, then Axis Bank begins its credit process by lending that money that it has got, the $10 billion that it has got in Indian currency, which then begins to impact first, because by working capital loans, current account, etc., the M1 measure of currency, and then eventually over a period of time, it adds to the M3 by this very important economic concept, financial markets concept called the credit multiplier, or more commonly known as the money multiplier. So that M3, the conversion of that base M0 money into actually productive transactions. So M3 is not a stock of money. It's not a stash of money. It's actually a transactional measure. How that existing stock of money, which is M0, then begins to get used for creating value, which is where the typical comparison that is done is M3 over GDP.
Yeah, so I think we're getting into theories here, but wouldn't you agree, sort of, Saugata, the fact is that, banks have parked 6 lakh crores with RBI. Is that a productive way to sort of reboot growth? I mean, where does that money have to go in now?
You're completely right. I mean, this is one of the things that is being debated so widely, that banks have become risk averse. Banks have gone through a very, very major credit cost, bad credit cycle. So unfortunately, in 2019 and in the first part of H1, as RBI data also now shows, there was actually signs of some improvement in balance sheets. You remember the previous chief economic advisor used to talk about twin balance sheets, etc. Now it's actually become 4 quintuple, quadruple balance sheets. Everyone is leveraged. So those balance sheets were getting deleveraged. Yeah. So people were drawing down their debt. With the IBC coming in, a lot of the bad credit was getting sorted out in the system. And that was one of the reasons that the NPA levels were coming down. Banks were becoming more healthy because they had been providing more money, they were drawing more capital, etc. So they were ready to lend. Then all of a sudden, so even before the COVID crisis, because of the financial markets condition tightness, because of the NBFC problems, etc., credit had been coming down. Banks had become, because NBFCs were one of the key channels that banks were using for on-lending to MSMEs, where NBFCs lenders were particularly strong. But because of all the problems, there was a degree of risk aversion, which now this COVID crisis has exacerbated, has aggravated very, very large. This is where all the government's programs, the backstop, the support, the partial credit guarantees, full guarantees, etc., the ECLGS scheme for loans, additional loans to MSMEs, These are where these instruments have now come into play. So we have already seen that banks under the ECLGS program have lent, the last that I saw was about, I think more than 80,000 crores, 800 billion rupees to MSMEs as part of the ECLGS package. So, and a large part of that is also from the private sector banks. So it's not just the public sector banks. So the credit conditions are now getting incentivized. And this is what the government can do in the current environment, that it can create incentives banks to start lending, clean up the others. You're hearing talk about this bad bank, the SPV, where some of the existing NPAs of the banks were being parked, maybe not such a good idea, etc. So some of these measures, both on the balance sheet side as well as on incentivizing credit, cash, and flows, credit flows into the system, are now beginning to happen. The government is now pushing. So now, rather than directly mandating banks, and it's not likely to happen because banks, public sector banks, which are a very large part of the Indian banking system, have no capital. India's current problem is not the 6 lakh crores that is parked with the RBI. It is a lack of capital, particularly for the public sector banks. It's a capital problem. So the capital has to come into banks for banks to start lending first, to provide enough loans. I mean, remember the GNPA and NPA thing that we were talking about. First, provide enough buffers for the bad loans in the system, and after that get capital to start the lending process again. So there are multiple dimensions to the current problem of credit not flowing. One, there is little demand for credit, particularly for large ticket capex projects. India, the capacity utilization levels are already very, very low, and people are not going to invest. So there is very little demand for credit. And even when there is demand for credit, many banks, a large segment of the banking system, is actually constrained by capital from lending even more aggressively than they are doing.
Okay, so Vinod, you wanted to respond to that in terms of what do you think with the perhaps solutions, as to the problems?
Yeah. I would honestly, I would just question the fundamental understanding of where the source of money is. I mean, I can be very objective in saying that there is no connection between deposits or savings and loans. And the empirical evidence is very objectively visible. If I go to Axis Bank today and I take out a personal loan of 10 lakhs, Axis Bank does not take that 10 lakhs from any account within its system to make that loan account of 10 lakhs. That money is brand new. It's created out of nothing and has no dependency on deposits. I think that's a major challenge I'm having in understanding why there is such a big disconnect in just understanding the reality of the source of money. So my first point is, we are not limited in India to create as much money as we want. The empirical evidence is there if you just look at the accounting within a bank. When the bank makes a loan, its assets go up, and it then looks at the net loans made during the day and balances off with the reserves, either by buying from the interbank lending market, by the repo rate loans that the Reserve Bank will give it. So that's my first point. I think there's a disconnect on the availability of the source of money. I think the money can be created by the banks. The banks are authorized to create it today. And we are talking about the stimulus of 20 lakh crores in India. If you just look at the top 10 banks in India, they have a lending capacity exceeding 20 lakh crores that they can deploy into the economy without needing permission from anybody, because they have the authority to do that based on the current Basel III norms and the Reserve Bank regulations in India. So my first point is, I think there's a confusion about understanding the power of the capability of banks to create money. The second point I want to make is a very simple point, and I'll try and describe it at the level, hopefully, that even a 10-year-old can understand. So let me just clarify that. Infrastructure is a big requirement in India. If you travel between India and any developed country in the world, the first thing that will hit you is the quality of the infrastructure. What do you need for infrastructure? We are talking about roads, bridges, and such. So what do we need to build bridges and roads? We need cement. Cement is limestone, plenty of it available in the country. We need steel. Steel is iron ore, plenty of it available in the country. We need energy, and we need labor. The four input components to create as much raw materials for infrastructure is available in India. Why do we need money from anywhere to support an infinite amount of infrastructure development in India. Sorry. So my whole point is, if there is an objective business plan, you need to have an ROI. So if you're putting up a highway, if you're putting up a bridge, you want to ensure that there is some ROI, there is some revenue recovery, in theory, to repay the loan created by a bank to fund that infrastructure. Okay, but for that infrastructure to be created, which is convert limestone to cement, convert iron ore to steel, use labor that is plentiful and lying underutilized in India for the purpose of building the infrastructure, and energy is the source of how you make these conversions and actually implement it. We don't need help from anywhere to do this. It is absolutely shocking to me that there is a lack of foundational understanding of how these things can be done. China is where it is today. The first thing that will strike you is the infrastructure. You cannot even compare the infrastructure that you see in China with the United States. China is far ahead. They're not even trying to compare with Dubai or the United States, the biggest, the best new cities. They are looking far ahead of that. The fastest train in the world is in China. In India, we are now in Kerala, we are talking about spending 65,000 crores on the slowest high-speed trail in the world that runs at 200 kilometers an hour. China is already got a train in production that goes in excess of 600 kilometers an hour. So I think, from my perspective, I would almost use the term that in some respects, I feel there is a lack of confidence in the country. I think in some respects, to be a little more radical, I feel we are almost functioning in a state of clinical depression because we don't feel anything is possible. But I would like to ask the question, what is holding us back to create as much infrastructure as we want? We don't need anybody's help. We have the raw materials in India, we have the labor in India, we have the energy in India, right? And the only thing holding us back is I would think it's a lack of understanding of how the system can work. We are running around saying we need savings. How in the world did we give? Today, 15% of the money that all of us use in our daily lives came from the RBI in terms of currency. 85% came from somewhere. Where did it come from? If you just look at the facts, it's pretty obvious that the root source of that 85% was bank credit. So bank credit is the source of a large segment of the money sloshing around in India that all of us used to buy and sell stuff.
Yeah, so I think, that's a fair point, but nobody's denying that bank credit is a fair amount of money sloshing on the system. I think you have a certain point of view, and Saugata also has a certain point of view. I think is talking about a more sort of established economic thinking is prevailing in India. You're talking about what you have seen in other economies and why perhaps we could not be as radical as from an entrepreneur's perspective that you envisage it to be. This can be the last round, I would say, and then we can get into perhaps 2 or 3 key solution or reforms that what India needs to get on a path of recovery. So Gata, would you want to sort of, respond to what Vinod just sort of mentioned? I think I could sense a passionate entrepreneur here who is trying to figure out that why can't we improve, the more credit culture in the economy, and why can't they perhaps more new money creation? So I think I would say that there's more passion speaking rather than an disappointment in the being an entrepreneur. I would say that, yeah.
Excellent points and very passionate address. You're probably, your net worth is almost, I'm sure, as close as Axis Bank's. So I'm sure, you have the means of translating your passion into some funds for India, which we sorely need at this point in time. So the second point is Axis doesn't print money. Far as I know, the last that I know, we don't have a printing press stashed away somewhere. The system, the RBI would look very, very askance at us. If we were to try to do that, that would be counterfeiting money. So again, let me emphasize that the only entity in India which actually prints money is the Reserve Bank of India. So no entity. All the rest of us just basically transfer. I
just want to clarify, that's the currency which makes up only 15% of the money supply. What is the source of the 85% that exists today that all of us are using for our income and expenses?
The currency is actually, the M0 is more closer to 25% now. So it's actually much higher now with the RBI printing money. It might be close to 30% for all I know.
I think as of this month, as of June, it's 15% of the total money supply.
No, it will be more. It used to be more. The M naught as a percentage of GDP is definitely more. I mean, so that you'll see. I'll give you the exact numbers. So that is more. Remember when we talked about, again, I'm not going to dwell too much on this, that M3 is not a stock of money. M3 is actually a measure of velocity, which is where that money multiplier, that stock of money, which is the exact amount of money which the RBI can account to the last paisa, because it's the one that's printing that money. I mean, you know, the bad notes come in, it is the one that is printing the money. So the RBI knows this down to the last paisa. How much? This is the best measured quantity of any entity in India. So based on that, banks typically using exactly the same credit process that you mentioned gets out into the system through increasing productive capacity, etc. So I'm not going to dwell on the mechanism of the money multiplier, the M3. There are many, as Shija mentioned, this is a theoretical thing, so I'm not going to. But remember, keep in mind that concept of the money multiplier, which is the translation channel of that base money stock into productive money, which is the M3 concept. To the more valid question that your impassioned address on why India does not need money, foreign money. Let's forget about that. I mean, you know, in a globalized concept, although I agree that level of globalization is coming in, we are trying to integrate into global value chains. So there's no reason why we should not be integrated into the global financial markets as well. There are many problems which your viewers would know, the impossible trinity, etc. I mean, you know, the amount of risks and volatility that flows into the system with excessive dependence, particularly on volatile foreign capital flows, etc. We know that. But given our intent to integrate into the global value chain, there's no reason why we should not be integrating into the global financial markets as well. The more important point, remember what we talked about, that there is an enormous amount of pools of foreign liquidity, foreign capital that are waiting to be invested. We are getting so much in terms of foreign pension funds, for instance, sovereign wealth funds, etc. We have created our own sovereign wealth fund, the NIF, that we were talking about. The key point, which is the government's, the Atmanirbhar presentation that the finance minister made over the course of the 5 days. Remember, Sriya, the title of the project, the 4 L's: land, labor, liquidity, and legal. There is a fifth L, which is, so the government's focus is entirely the land, labor, liquidity, enforcement of contracts, the legal part. And this is what is a key concept, key problem now for India, getting tons and tons of foreign liquidity to foreign equity and debt capital to fund India's infrastructure. So ideally, we should be dependent on our own resources, which is what China did, 50% savings rate, as opposed to at our peak, the 38%. So China was at that time 54%. Total savings. And this is the reason that domestic investors in China do not get more than 0.5% on the deposits. India, if we would have a social unrest, I mean, if the government were to try to bring down that level of deposits. Already SBI's savings bank deposit rates is about 2.7%. Yeah. So, I mean, there's a large segment of depositors that now are starting to get affected in this. The point is, India needs to now get moving on improving all of these 4 L's, particularly the fifth, which is logistics. India's logistics costs are about 13 to 14% of GDP. All our peer export competitors are in the single digits, which is what Honorable Nitin Gadkari Sahab keeps on mentioning, harping on again and again in his addresses, that we need to get logistics costs down, which is where our focus, the investment focus now, the warehousing structure. And very, very coincidentally now, in this process of the e-commerce marketplaces now happening, this is exactly one of the things that is now beginning to get improved. Because now you're going to all the e-commerce players in the system are developing their own the warehousing and retail and distribution chains, etc. So this is what is beginning to improve now. So the fifth L that is beginning to improve. We are making enormous efforts to try to move on the other 4 L's as well. In terms of what Vinod Saab said, I completely agree with him that we need to get our project implementation capabilities, capacities much improved beyond what the dedicated freight corridor. One of the key points of improving India's logistics process, the separate rail tracks for freight movement, etc. Conceptualized in 2007 Now the current date is, the completion date is 2023. China would probably have finished it in 10 years. So this is something that, and the government is very, very aware of this. I mean, it is seized, as they say, of this problem. The Surjit Bhalla High Level Advisory Group report, which is the roadmap for increasing export competitiveness, essentially deals with all these problems that Vinod Saab mentioned in his impassioned address. This is the rational part of moving step by step in this process. One of the key things is now all the things that Vinod Saab you mentioned, the 4 L's of the government, is largely in the domain of states, not in the center. There are a few things that the center needs to do in terms of taxation, etc. But largely this is in the domain of states, which is where the federal structure and center-state cooperation has become so important now in this current environment. So probably, I mean, this was an equally impassioned address, and I completely agree with him that the core part is not money. It is not trying to force credit down somebody's throat. It is to develop the credit ecosystem, the ability for things will go wrong. I mean, that's the basic business of banks. Banks are in the business of taking risk. However, the risks need to be controlled. And one of the largest part of controlling risk, and one part is the IBC system, which has changed the credit culture in the country, corporate credit culture in the country. So there are similar steps. The credit score, bureau scores, CIBIL scores, etc. Borrowers now are so aware of their credit scores that they do not want to risk borrowing something if they know that they will risk spoiling their CIBIL scores sometime in the future. So these are things that have actually slowed down credit, but is creating a massively strong credit culture, which I can assure you, whether it be 1 year, or 2 years, or 3 years, I don't know. But this is setting up the stage for a very large increase in total flows of funds, bank credit, mutual fund credit, NBFC credit, all India financial institutions, corporate bond markets. You wouldn't believe it, the amount of flows that are now in the process of being channeled into the system in the next 5 years.
Great. So I finally see some convergence, and actually huge amount of convergence between 2 players, an economist and entrepreneur. Wow, we should just applaud ourselves for this. Really. So I think there's just the last concluding remark, if we were to sort of draw up like a 5-point agenda on what this government needs to do, or perhaps, on the rebooting economy, and if we were to sort of develop a certain kind of manifesto, for the policymakers, what could that really be? Perhaps 2 points from you, Vinod, and 2 points from you, Saugata. We can do a conclusion and get on to the rapid fire then. Yeah, Vinod.
Yeah, so I think in terms of what the expectation would be, right? How can we effect practical change for the better? I would say the first thing is it revolves around credit creation, because that is a source of capital for all the investments that happen in the country. And you got to remember that 70% plus of the meaningful jobs in the country are with the SME sector, which has, I'm not really sure that it's easy to get credit for that sector, right? Because it is the most difficult thing when I talk to my peers as well. So I think the government should focus on policies in relation to credit that contributes to inflation, and credit that can contribute to non-inflationary lending. Okay, so what I mean by that is, if an individual in this country is taking a loan to buy an existing home, as an example, that is 10 years old, when that transaction tax takes place, at the point of that transaction, there is no contribution to the GDP in terms of new products and services related to the transaction. The only thing that is happening is the transfer of the title of a home from A to B. And for the purchase of that home, the money created, let's say it's 1 crore to buy that new apartment, is brand new money created in the system that actually contributes to the inflationary side of things, where you're increasing the money supply without increasing the products and services. So there's a risk of inflation. And we do see reasonably high inflation in the country right now. So I think the support should be for non-inflationary lending, which is lending in support of productive output, because that ensures that the new money being created results in the creation of new products and services, which sets it off. So you cannot have an increase in prices theoretically. And again, you got to understand that the basic essentials for the citizens of this country are food related. And if you get 10 times more money, you're not going to buy 10 times more food. So there is a limit to inflationary impact on basic essentials. So we don't need to worry about inflation in that area. We just need to worry about inflation in the broader economy. And as long as credit is provided in terms of new money that contributes to the creation of products and services, we should be just fine. And I think we can see a much faster, rapid growth in the country. And then the last part of this is the cost of credit. I think if you look at the stimulus program, there's a lack of focus on the impact of the cost of credit here. Because if you're talking about a loan at 8% interest or 10% interest, the entrepreneur or the small business has to make a margin greater than that just to be able to afford to repay the loan. That has an impact on NPAs, that has an impact on the success of the business, and that has an impact on the motivation of entrepreneurs or small businesses to expand their business. I think there's a lack of focus there because the assumption, which I believe is false, is that the traditional interest rate has to be addressed. The traditional inflation rate has to be addressed when defining the interest rate for a loan. My position there is you could almost have a negative interest rate if you're targeting with credit guidance a loan towards productive output. So for example, we are trying to increase the production of seafood. You might have seen the controversy recently that you've got Chinese fishing vessels that are much larger than the Indian vessels doing deep sea fishing off the Indian borders. And our industry can't do that because we don't have the economic capability to get access to that size of fishing vessels. What if you had a negative interest rate loan to stimulate that sector? I literally mean, when you give out 100, you're expecting to get repaid 90. So the point is, this sounds unconventional, but when you really look at the facts, you're targeting through credit guidance the stimulation of certain sectors that can contribute to the overall availability of basic necessities for the citizenry. So I think my conclusion in terms of my position is, firstly, we really need to apply first principles on the creation of money, because I think there's a little bit of confusion about that. It doesn't comply with the established norms today in terms of what is the meaning of money. And you can see the fear of even in the stimulus initiatives, right? Because there is a fear of inflation, and we have not done anything in putting money in the hands of the people who need it. What we have done so far is created a structure for liquidity to businesses to lend money, mind you, at the same traditional interest rates. So when businesses in this crisis have zero income, why would you take a loan and take the penalty of the interest rate unless you had some benefit? So if you had credit guidance that said, listen, you can have a loan at literally 1% interest rate as long as you're using it for capital expenses and such, now you're going to boost demand, you're going to boost productivity, you're going to create new jobs, you're going to help the real economy, right? Without any impact on inflation, because every penny lent in that segment is now creating products and services that offsets the new money created. So I would say credit guidance is something that we need to look at very seriously, because you don't want to just create money for the sake of inflationary purposes or inflationary credit. You want to create new money for productive credit that contributes to the products and services available in the country.
Interesting. So I think we have had spent a little bit of time on credit guidance already, but I think some interesting ideas coming to the fore from Vinod here. I spoke about negative interest rates and really contributing to the real economy and not really adding to the inflationary side of it. Two concluding remarks from you, Saugata. What would those really be, and what could actually sort of, transform India's path to recovery? What would that really be? Propel it to that path to recovery.
So maybe, 2 points. Maybe I'll split it up into 1A, 1B, 1C, 2A, 2B, 2C a little bit. So I completely agree with Saab's statement that we need to reduce our cost of capital. To my mind, reduction in the cost of capital, interest rates, etc., depends on the risk profile. So we need to de-risk our system to be able to for credit to flow in at lower cost. Inevitably, this is like a mathematical equation. You reduce the levels of risk, your cost of capital will come down. One sector that we need to focus on, and the government has shown incredible regard, the 3 or 4 reforms that it's already announced in this segment, is agriculture. So we need a completely different business model for agriculture. India has huge potential in the agricultural sector, particularly in the allied services, animal husbandry, fruit farming, fisheries, the blue economy, etc. So that's one. A large part of agriculture is related to land. So the next point that I have is land reform. So the 4 L's that we remember that the government has talked about, land. Particularly in land, the digitization of land records is very, very important. One of the key reasons our project implementation capacities are low in the country is because of problems in acquiring land. Nobody has an idea whether land titles are clear or not. So digitization of land records, as Kerala has done, as Telangana has done, I think is absolutely critical in terms of incentivizing project implementation. Talking about digitization, I think the third issue is the entire digitalization initiatives that is happening underway in India. I think this is something which needs, I mean, the fintech community, which Shrija, you are the expert in this area. I think this needs to be now the key focus of the government in terms of making things more efficient, processes more efficient, and we are already seeing. I mean, this has many multiple implications. These need to be thought through, and appropriate regulations need to be put in place to harness the prowess of digitalization that is inevitably likely to happen. And Vinod Saab, you of course are one of the key players in this area. In terms of de-risking, I think the fourth aspect, legal, fourth element, judicial reforms. India is regularly doing badly on the enforcement of contract vector of the ease of doing business rankings. So, and a lot of the risk relates, believe me, relates to the legal system. I think government needs to put in place judicial reforms, etc., to make decision making more fast. Things will go wrong. I mean, and this is what is the key difference between the US and India. They accept that if risks are inherent part of the business, but we need to move on quickly. I mean, you cannot have things lingering in courts, so judicial reforms. And finally, in terms of a broader framework, in terms of the judicial reforms, I think we need to increase state capacity building at the state levels, particularly at the state government level and at the municipal government level. I think that is what needs to improve, because a large part of all we talk about in the air, etc., is actually implemented at the municipality and the panchayat level, and that is where capacities need to improve in the system.
So yeah, we heard both sides of the view. One could sound radical, unconventional, and one sounded more like what is on the ground but can be implemented. Now it's time for my rapid fire. I'll begin with you now. First, Saugata, then get on to Vinod. Your advice to the RBI governor if you're stuck in an elevator with him, a 2-minute pitch.
Going great guns. I think this governor is a risk taker. So I mean, controlled risk is what the governor, and together with his team, the RBI team, is, and they need to keep up with it. And RBI is the forefront of the stimulus.
Okay, how will 2020 go down in history?
Pretty bad. I mean, you don't need to say. I mean, the black swan of black swans, the blackest of the black swans, and we've got a first-hand experience now of what a pandemic looks like. So I mean, that's the only bright part. So it's a new experience for but the blackest of the black swans in history.
Okay, the blackest of the black swan. The former RBI Governor Raghuram Rajan recently said in an interview that we need transformational reforms. If you were to mention one transformational reform, what would that be? Transformational.
Abolish the APMC Act seriously. So government has already started. It's abolished the APMC Act, but this needs to be taken into the state levels. So the agricultural produce marketing committees, which is where farmers were required to sell, they're no longer now. So abolish APMC is already done. Put in place the e-marketplace system, the agriculture e-marketplace system. Put that in place. So farmers have a nationwide market, export markets for their produce.
Okay, my last question to you. Universal basic income, giving money into the hands of people, an idea whose time has come.
Yes. In some form or the other, we cannot have a full universal basic system. So India's resources, we have to live within our means. So it has to be not a universal, but a quasi-universal. And a lot of programs are already being designed. I mean, the entire JAM Trinity, Jandan, Aadhaar, mobile, the Trinity, JAM Trinity is already designed to move towards a universal basic system. And we have seen a fairly significant manifestation of that during the transfers, during the part of the survive part of the recovery process that the government has put in place in terms of the food transfers, the cash transfers, etc., particularly to women and scheduled castes and scheduled tribes that you've already seen in the system.
Okay, I get to the entrepreneur now. We know the rapid fire. How will 2020 go down in history?
I think it's going to go down as a transformational year, which is a huge opportunity. In our sector with technology, we have seen it as being transformational in terms of actually growth in the business. We are really concerned But in the real economy, there's a lot of pain. I think it's a transformational moment to relook at the basics, go down to first principles, and really, take some risks. We cannot address the challenges posed by this problem through conventional thinking. We have to look at taking risk. And that earlier point you mentioned, sorry to extend my answer here, but about the RBI governor's policies, I would say totally look at non-inflationary lending. Just practically think of the impact of a loan available at 1% for capital expenses or purchases of new goods and services. That will have a huge demand and will create jobs and will not impact inflation because it's directly contributing to the increase in products and services as well. So that's just a quick answer there.
Okay, since you're a fintech entrepreneur, I would like to ask you, what do you think is the future of banking?
I think it's going to be more digital, right? So banking is highly regulated because it's the only industry with the authority to create money. Sorry to beat that horse to death here. But I think it's going to be purely digital because we are in the middle of that, and we are in the automation space. And, it is questionable looking at the purely digital banks that already exist in the West. It is questionable on the need to walk into a branch to pretty much do anything, right? So I think it's going to be a transition to a digital, purely digital experience. We are already seeing that happen, driven by the COVID crisis. So we have a lot of clients where we allow them to open accounts without a customer walking into the branch because they can do it fully digitally, fully online. So I think it's going to be an acceleration into a purely digital experience.
Okay. The biggest fad of 2020, what would that be according to you?
I think it is the concept of switching on video in these kind of meetings. We could have done it 10 years ago, but we always did it as voice calls. Now with this COVID crisis, we're doing it on video, and I think the concept of work from home. I mean, for us, it has been humongously successful, I must say. We have almost seen a 25 to 30% growth in productivity. We are in the software and technology industry. So fortunately, we are able to work from home. So I don't see us going back to the old normal. I really don't see us going back and working 9 to 5 in a cubicle any longer. It's going to be a mix of both. And the data for us is showing that the productivity gains are significantly higher and the work-life balance is exponentially better with the flexibility to work from home.
Okay, I will ask the same questions to you. Raghuram Rajan recently said in an interview that we need transformational reforms. One transformational reform from you, what would that be?
I would say completely address the cost of credit in India, because that is the real deal breaker. Make credit available, like Saugata said, it is available, but not at the cost of it today, not at 10%, 8 to 10%. If you bring it down dramatically and target it at productive lending in terms of direct proportion to the increase in products and services, you can control inflation. And I would say that is the way to go. And the evidence is already there. Everybody in the West is doing it with successful outcomes. And I think we need to do it quickly.
And my last question, universal basic income, giving money to the hands of people, idea whose time has come. What do you think?
I am most passionate about that subject, honestly. I would go as far as saying that it is almost a human right in this day and age. It is shocking to hear about people dying of starvation in India in 2020. It is an unheard of concept. So I would say, I would even go as far as putting a number to it. I would say we need to be giving people 18 years and above 3,000 rupees, whether they like it or not, in their hands every month. And we have the capacity to do it because I think the biometric authentication we have in India with Aadhaar is phenomenal. And we have 1.2 billion people on Aadhaar today out of a population of 1.3 billion. So we have a very simple mechanism and infrastructure already in place to execute on it. And that would be, I think, a huge win and actually leapfrog what the rest of the world is doing, because India really needs it. And the rest of the world is talking about $1,000, $2,000. We are talking, I mean, what is 3,000 rupees? It's less than $50 a month, right? And it's not going to impact inflation like people think. I think it's going to stimulate demand, because what are the bare necessities today? It's roti, kapda, makan, and a data plan, right? Because you can't live without data. And all four are very accessible with very little money in this country. So why make a fuss? Just give it to people. And I think the key thing about universal basic income is the meaning of universal. Because every time we try to implement a selective program, 80% of the resources are consumed in the selection process. instead of that, when it's universal, you don't need to think about it. If you're alive, you're a citizen of this country, and you have an Aadhaar card, you get $3,000 every month. That's my statement there.
Okay, thank you, gentlemen. We had a pretty meaningful conversation here, and we sort of attained clarity through debate on various points on the aspect of money creation, rebooting the Indian economy, what the government needs to do, what the government should do, and perhaps also bringing some unconventional lines of thinking to the table. Until the time we see you next, goodbye and good luck. But thank you for putting your time and energy to this. And do tune in the second episode of India Restart. Till the time we say goodbye and good luck and stay safe. Thank you.
Thank you, Srija. Thank you, Saugata. Have a good day.
Thank you, Srija. Great talking to you, Vinod Saab. Srija, I know this is cheating. In the rapid fire question, you need to. I mean, in the what does 2020 mean to you? You need to include this, man. I mean, this is the Hindi version. So this year showed the difference between 19-20 का फर्क. 19-20 का फर्क. This year showed that difference.
Thank you.